Welcome to vTalkInsight, Allocator's Lens Daily from March 6, 2026. A fast-moving conflict in the Middle East has choked key energy routes, pushed oil sharply higher, and reignited inflation worries, even as U.S. growth and earnings stay resilient. We will look across equities, rates, credit, FX, and commodities to understand how this new energy shock is reshaping risk and opportunity across portfolios. In global equities, the central tension is how long headline indices can shrug off an escalating energy and geopolitical shock. U.S. stocks have been volatile but broadly resilient, with recent pullbacks followed by quick recoveries as strong services and labor data underpin dip buy. That economic backdrop is reinforced by upbeat news from the AI complex, where leading semiconductor and hardware names are guiding to very strong growth in data center and chip demand. Together, those forces have kept risk appetite alive even as day-to-day price action has turned choppier. Under the surface, dispersion is sharp. Energy has led performance over the past week as crude surged on the effective shutdown of the Strait of Hormuz and attacks on regional infrastructure, lifting oil prices by more than 10% from recent levels. Yet several signals point to stretched valuations and heavy inflows in energy equities, and even episodes where the stocks have lagged the latest spike in oil. That gap suggests equity investors are no longer fully endorsing the move in the commodity and are questioning how long elevated prices can be sustained. The AI and semiconductor space remains a key support for broader indices. Guidance for very large AI chip revenues and accelerating demand for semiconductor materials underpins the idea of a multi-year capital expenditure cycle benefiting U.S. hardware and equipment leaders. Some see mega-cap U.S. tech regaining appeal after a period of underperformance, with scope for capital to rotate back from markets that had recently outpaced it. Others, however, highlight that valuations across parts of tech still look demanding and increasingly sensitive to any delay in rate cut expectations as energy-driven inflation pressures reemerge. Regionally, Europe and parts of Asia appear more vulnerable to the Middle East shock than the U.S. European indices are under pressure as rising oil, gas, and jet fuel costs hit travel, consumer, and industrial names, while dependence on imported energy clouds earnings visibility. In Asia, Korean and Taiwanese markets, which are heavily concentrated in AI and crypto-related sectors, have suffered violent reversals as leverage positions unwind. Across these regions, several observers argue that equities may be underpricing the risk of a prolonged conflict and stickier inflation, especially when compared with the bond market's repricing of policy paths. Key watch points now are the durability of U.S. earnings resilience, how far the AI story can offset higher discount rates, and whether further oil spikes finally trigger a broader derating. In rates, the story has pivoted decisively toward an inflation and policy repricing driven by the energy shock. U.S. Treasury yields have risen for 4 straight sessions, the most persistent move higher in months, as markets question how quickly the Federal Reserve can ease while oil and gasoline prices jump and activity data surprises on the upside. Commentary suggests investors still see the policy rate as meaningfully above neutral, but the path back toward that neutral level has become less certain. Recent inflation readings sit in the mid-2 to 3% range, with housing and services cooling, but core goods firming on tariffs and supply frictions. Officials describe the current stance as appropriately restrictive and signal no urgency to move, while stressing that a prolonged period of elevated energy prices could delay or even reverse previously expected cuts. In the U.S., the message is one of caution rather than renewed tightening, with policymakers waiting to see how much of the oil shock feeds through core prices. In Europe, bond markets have gone further than equities in pricing an energy shock. Yields on German and peripheral sovereigns have edged higher, and forward pricing has shifted away from a clean, easing cycle toward the possibility of renewed tightening if imported inflation persists. For allocators, this backdrop raises 2 concerns. Higher and stickier yields may coexist with only modest equity weakness, eroding the traditional diversification benefit of duration in an inflation scare, particularly in Europe. At the same time, while long-term inflation expectations remain broadly anchored for now, persistent headline pressure from oil risks challenging that stability if the conflict drags on. Incoming data on energy pass-through especially into Eurozone inflation and U.S. core measures, together with central bank communication around the war's duration, are likely to drive the next leg in the rates narrative. In credit, surface calm masks growing pockets of stress. Public credit markets still look relatively orderly, with no sign in spreads of a full-blown funding squeeze. Yet the combination of higher base yields and energy-driven inflation risk is starting to expose weaker links. The most visible strain is in emerging market sovereign and quasi-sovereign debt. Bonds across parts of the Middle East, Africa, and high-yield Europe have seen meaningful outflows as investors react to geopolitical uncertainty and the prospect of higher for longer global rates. Countries reliant on imported energy or vulnerable to capital flow reversals are singled out as particularly exposed if risk aversion deepens. Currency weakness, higher domestic fuel prices, and tighter financial conditions can interact quickly in these markets. Private credit is another area of concern. A recent write-off of a mid-sized private loan to zero by a large manager has sharpened attention on valuation practices, documentation and liquidity mismatches across the asset class, and raised broader questions about where risks are really sitting. Against that, there are still examples of resilience. Greek banks, for instance, are highlighted for conservative loan-to-value ratios on shipping exposure, suggesting some parts of the system can absorb volatility in oil and freight provided the crisis does not become prolonged. The overarching message for allocators is that headline credit metrics may understate tail risk. Monitoring flows, refinancing conditions, and idiosyncratic defaults, particularly in emerging markets and private structures, looks more informative than relying solely on index-level spreads in the current environment. In foreign exchange, the Middle East shock is reinforcing an existing pattern of dollar strength and pressure on energy importers. Robust U.S. data and relatively limited domestic exposure to imported crude are supporting the greenback as both a growth and safe haven currency. At the same time, some see the latest leg of the dollar rally as extended and expect a period of relative stability from here, which, if realized, would reduce currency headwinds for U.S. corporate earnings. Europe stands out on the other side. The euro has weakened as markets focus on the region's dependence on fossil fuel imports and its higher sensitivity to oil and gas price spikes, which could limit how far the European Central Bank can ease. Emerging market currencies are under particular strain. Volatility has picked up in energy-importing economies and central banks across Asia, including India, Indonesia, China, and reportedly Taiwan, have stepped into the market to lean against disorderly moves and disruptive capital flows. Those interventions underline concern about the feedback loop between weaker currencies, higher local currency fuel prices, and inflation expectations. In several cases, policymakers are being forced into a more defensive stance, just as growth is challenged by external shocks. Taken together, FX markets are amplifying the divergence seen elsewhere. The U.S. appears relatively insulated, Europe and parts of Asia look squeezed, and many emerging economies face a tougher trade-off. For cross-border equity and bond portfolios, the key watch points are whether dollar strength begins to cap risk appetite and how far central banks are willing to use reserves to smooth volatility. Commodities sit at the heart of today's macro story, with the energy complex under acute stress. Military escalation across the region has led to attacks on infrastructure and tankers and has effectively reduced traffic through the Strait of Hormuz to a fraction of normal volumes. That disruption has driven crude benchmarks sharply higher, including a recent single-day gain in U.S. oil prices of almost 10% and spot levels now comfortably above $80 a barrel. Markets are wrestling with whether this represents a step change in the price floor or a spike that could reverse if shipping lanes reopen. The stress is not confined to crude. Qatar has declared force majeure on some liquefied natural gas exports. China has halted fuel shipments abroad, and several refineries and gas processing facilities in Saudi Arabia, Iraq, and Qatar have been damaged or idled. Diesel and jet fuel prices are rising faster than crude, squeezing transportation and travel, while European gas prices face renewed upward pressure just as the region was beginning to recover from previous energy shocks. These moves raise the risk of another wave of cost pressure for households and industry. There are few partial offsets. India's renewed purchases of discounted Russian oil provide an alternative outlet for some barrels. and current Brent levels, while uncomfortable, are still below past crisis peaks, suggesting prices have not yet reached worst-case territory. Even so, multiple comments stress that supply chains are being rerouted around conflict zones, tanker markets are tight, and shipping and insurance costs are building a structural premium that is unlikely to disappear quickly, even if tensions ease. Gold rounds out the picture, extending its haven rally as investors seek protection against both geopolitical escalation and inflation risk. The attraction of bullion is reinforced by concerns that traditional safe havens have not always provided reliable protection in recent risk-off episodes. For allocators, the core question is whether this evolves into a sustained, broad-based commodity upswing that entrenches stagflation fears, or remains a sharp but ultimately transitory shock. The duration of the conflict and the speed with which key shipping lanes and facilities can be restored will be critical in determining which way that balance tips. Stepping back across assets, the picture is one of rising tension between an intensifying energy shock and still resilient growth, particularly in the U.S. Equities remain supported by earnings and powerful AI and semiconductor narratives, yet appear more relaxed about Middle East tail risks than either rates or commodities. Bond markets are already adjusting to the possibility of higher for longer policy. Credit is starting to reveal stress in emerging markets and private structures, and FX is channeling pressure toward energy importers while reinforcing dollar strength. Commodities, led by oil, gas, and gold, sit at the center of the regime debate. For allocators, the near-term focus is on how long oil and gas prices stay elevated, how central banks frame that within their reaction functions, and where liquidity proves less robust than assumed. Cross-asset signals, especially the interaction between crude, yields, and equity volatility, will be key indicators of any shift in the investment landscape. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.